on the situation, we are now joined by Abhishek Goenka, founder IFA Global and Billions, and Navneet Damani, who's the VP Commodity Research, Motilal Oswal Services, joining us. Hi, good afternoon to both of you, and thank you so much for joining us, Abhishek and Navneet. My first question is: the slide underscores a divergence in India's domestic and external macroeconomic position. Now, while GDP growth has been stronger than expected, punitive US tariffs and weak capital flows have piled pressure on the rupee. Now, the rupee has in fact fallen 5.3% year to date, putting it on track for its steepest annual decline since 2022 and making it the worst performing Asian currency. Really, is it time to lose sleep over it? And is this weakness likely to continue? Because up until now, it has not had any material impact on the inflation so far.
Yeah. So, to me or?
Right, go ahead, Abhishek.
Yeah, so as I was telling you in the morning show, that there's so much of negativity around the dollar rupee, about Indian stock markets, in terms of capital outflows, etc., etc. And we tend to forget that we are the fastest growing economy. Our current account deficit have deteriorated a little bit, but we were still some time back, we were below 1%. And that was a great number. Because consistent capital flows are happening, our all-time FII holdings of Indian equity has also hit all-time low. So I think we should not get so negative. Our inflation is fine, even if we take into account the relative inflation between India and US. And even if I don't take 0.25% as inflation and take, say, 3%, then also from a relative inflation basis, the currency has depreciated a lot. That's point number one. Gold imports have increased, because of which current account deficit numbers are looking bad, which sooner or later is going to be fine. Growth numbers are good. Fiscally, we are fine. So, and the most important thing is that this year, as you said, we have been the worst performer in terms of currency. So, we're at least 2 standard deviation away from the mean when it comes to rupee depreciation. So, I personally feel that short term, of course, there are a lot of negativity in the market. But in the long term, I think 3% depreciation of rupee is what generally is seen in India. And this year around, we are close to around 5.5, 6%. So as soon as things get slightly better, we should see a better rupee. So I'm not in a camp where I'm looking at a runaway depreciation of the rupee. I'm more in a camp where I think things should settle down. Also, one interesting thing that we watch is the volatility. And the volatility, the walls in the dollar rupee has still not crossed 4%. So I think I don't understand why there is so much of panic because of the 90 figure. I think we have seen 6-7% depreciation earlier also, but normally it then settles down at around 3% depreciation. So I would say exporters have taken opportunity about 90. In fact, a lot of our clients have covered at 90 plus. And I think these are good levels to cover for 1 year. And one should not get so panicky about the rupee depreciation.
Right. So, Navneet, Abhishek is in the camp where he is perhaps not panicking or losing sleep over the depreciation in the rupee. What about you? Are you in the same camp, or do you see further depreciation of the rupee? What are the levels that you're tracking?
Well, many in the government have also mentioned that they are not losing sleep over the rupee because of the depreciation or the 90 level it's hit. And ideally, that is not the case, and it shouldn't happen that one has to lose sleep. Predominantly, if you see the last 45 years data or 40 years data, you see that in a bracket of 4 years, rupee tends to depreciate by 12% on an average every 4 years. So ideally, there is no fixed rule whether it will happen 4%, 3% every year, or it will happen in a short span of time of by about 10-12% in 1 year, and then it goes. This year around, when you see 2023-24, it was pretty flattish between 80 and 83, and now in the year 2025, we are seeing some bit of depreciation. So this 3-4 year bracket, we are seeing rupee down by about 10%, which typically has been the case for the last 45 years or so. So it's not much of a worry. This kind of depreciation was warranted, and it's already come into action. It is only that the psychological level of 90 has been hit, and you have a strong GDP data of about 8% plus. You have inflation well within control of below 2%. That is what is not able to do. People are not able to do the math that if something is so perfect, then why is the rupee depreciating? There's a long capital flight from Indian equity market that we've been witnessing over the last couple of years. If you see 2024, there was a big outflow in 2025. Since April to now, roughly around $15 billion worth of capital has flown out of the country, which is leading to the fall depreciation. Secondly, we also see that the trade deal negotiation has been getting delayed and or maybe postponed for the last couple of weeks or so, where which is added fuel to the fire, where it looks like the negotiation getting postponed, and if at all there is no probably a middle path between in the negotiation, then the fall could extend or could continue towards 91 and a half, 92 the levels also. In say maybe 24 hours from now, we have the RBI policy meet, and the commentary will be very important to see. It is not that the forex reserve have been compromised. They have come down from $702 billion to about 688 billion dollars, and the RBI is not intervening much at this point in time to safeguard the rupee, understanding that it's a natural process, and eventually when they feel the heat, they will start and intervene. So overall, from a macro framework, it looks like the move largely has played off. Maybe if the trade deal gets delayed beyond a certain point, you might see further round of depreciation. If at all, in the next policy meet tomorrow and between the next week when we have the Fed policy meet, there is a statement which doesn't go too well for the economy, then you might see otherwise largely the depreciation part is taken care of.
Right. Navneet, you mentioned an interesting point that, if everything is so rosy and perfect, why the fall in the rupee? I mean, clearly there have been a continuous FII selling, but tomorrow is the policy decision. The RBI is walking a tightrope. While, like you mentioned, the growth remains robust, there's a significant decline in the retail inflation in October. That has created additional room for a rate cut. An interest rate cut does not really augur well for FII outflows unless the US also cuts rate and the yield advantage of investing in India becomes more attractive.
So,
Well,
uh, what I feel is
Yeah.
that we should not connect interest rate cut with the rupee. A lot of people are connecting right now. I think it's an independent decision because our inflation is very much in control, and we have seen historical low inflation. And I think market is kind of pricing an interest rate cut, that possibly that can happen. And especially now the rupee has also corrected 50, 60 pesos this morning. If tomorrow, if it's another 20, 30 paisa down and there's an interest rate cut, anyways, we don't attract so much of flows in the debt markets. It is always equity for India. So I don't think that an interest rate cut would be something which is going to be taken negatively. In fact, the way I look at it is, despite all this negativity around rupee, if there is a rate cut, I think it's a positive signal. That means uh, the government machinery is very comfortable. So I think rate cut is good, and if it is there, definitely it's going to boost our equity markets and also going to boost our growth, which ultimately helps investors in the long run, and that's what people are watching.
Navneet, do you concur with Abhishek? Now that is perhaps probably if the rate cut goes through. He said that it is could be positive, so it is sentimentally positive. But does it necessarily mean that it could be good for the rupee?
Well, I don't think rupee is going to have much of an impact because of the rate cut. It is more of sentiments which is kind of playing around on the rupee at this point in time. And between tomorrow to the next week, you have the Fed also, which is going to cut rates. There's a probability of 90% of a 25 basis point cut. So if that both the economies tend to decide to rate cut by 25 basis point each, then the volatility to a very large extent will be curtailed. It is more of the commentary which is going to come from the RBI and from the Fed, which is going to decide the course of the INR. Along with that, very important factor, as I'm continuously mentioning, is the trade balance, which is now current account deficit, which is anticipated to be upwards of 1.2 to between 1.4%, which has to be kind of addressed, because we were under 4% for the last year or so, and if this time it shoots up above 1.4, 1.5%, then the next round of depreciation is underway. I don't think we are focused on this, but probably as we approach the next quarter, that will also start to play around on the rupee in a very large extent. So trade deal coupled with the Fed rate cut and RBI rate decision is going to going to draw the rupee for the next few months.
Right. Okay. Point taken, Abhishek and Navneet. Thank you so much. We're timed out on this discussion. We would love to have more, but we'll let you go.